Well, again, thank you everybody for joining us today. We are here to present our webinar, Strategic Site Selection, Leveraging Tax Credits for Business Growth. I do have some housekeeping items to run through before we get started. So first, if you would like to receive CPE credit for today's session, please be sure to respond to the 4 polling questions that will pop up throughout the webinar. CPE certificates will be sent via email within the next 2 to 3 business days. If you have any questions related to the material, please submit them via the question feature on the control panel. If your question cannot be addressed during the session, a member of our team will follow up with you following the webinar. The presentation slides may be downloaded from the handout section of the control panel, and this webinar is being recorded, then will be sent out for on-demand access in the coming days. And lastly, please be sure to take the short survey that will pop at the end of the webinar. And with that, we'll get started. I'm Sabrina Champagne, the Director of Employment Tax Credits here at Sikich, and I'm joined by my esteemed colleague, Jenny Massey, who is the Director of Site Selection and Incentives within our practice. Together, we bring a combined total of over 30 years of experience in both the site selection and tax credits industry. We've worked with numerous organizations ranging in size from small startups up to very large Fortune 50 companies. And during today's webinar, we're going to be addressing a few of these items. First off, we'll start with understanding what site selection is and that process. Then we'll move on to the types of tax credits available to companies, the importance of evaluating locations, and how that can maximize your tax credit benefits. Then we'll walk through both the application process and then, more importantly, the compliance and reporting to ensure that you monetize these benefits. And before we move on, here is a quick legal disclaimer that I'll leave up for just a moment so that everybody has a chance to review it. And with that, we wanted to provide a little overview of our firm. For anyone who is unfamiliar with Sikich, first off, welcome to joining our webinar today. We are a global company specializing in technology-enabled professional services. Here's a snapshot of all of the services that we offer. We are 2,000 professionals strong with over 15,000 clients and 15 locations around the world. And what better way to start off a webinar than with our very first poll question? Jenny, would you like to take it from here, please?
Absolutely. So first poll question, what is your company's primary goal when exploring tax credits and incentives? Reducing overall operational costs, supporting business expansion and growth, enhancing employee training and development, investing in technology and innovation, or unsure, we're just starting to explore tax incentives. Looks like we're about 80% voted, 85. And looks like 36% said just starting to explore. So that's really interesting. And then 30%, was the next one, said reducing overall operational costs, which is absolutely what incentives are supposed to do. So perfect.
Great. And Jenny, we'll go ahead and kick it off to you to provide some insights about understanding site selection.
Perfect, thank you. Okay, so our site selection practice is an independent practice. And so I just want to talk about what that means. It just means that we are not associated with, let's say, a real estate firm or another firm that has interest in directing you towards a real estate piece of property or something. So we actually can work with everyone. So we can work with any real estate company, banker, whomever you want to work with, we can work with them. So it just means the tools are there, the tools that we can work with are there. And I think that kind of helps us in many, many ways. But so we specialize in helping companies minimize risk and maximize return from expansion projects. So incentives definitely help to offset your costs. I think we can go to the next one. So definitely there's a process for site selection. So we help define the project. So we actively listen to what our clients are doing, and we match those up with incentives. Not everyone needs to find a site. So if that is necessary, then we locate sites. We definitely can help evaluate the sites. Sorry, my computer. Coordinate site visits. Then we negotiate those incentives, get your agreements in place, and then work through the compliance process. So there's a tried and true process. Not everybody needs everything in this process, but we work on an individual basis with our clients to give them what they need specifically to them. So there are two sides to economic development. So on the one side, we have economic development organizations. So local economic development organizations, regional EDOs, so LEDOs and REDOs, and then state EDCs. And really, site selection people work with them. So site selectors like myself and Sabrina are the consultants kind of in the middle between a company and a local or state economic development group. So it's kind of our job to be between both sides, because that way each side can be completely honest with us. We know the process, we're able to set expectations, we're able to push the project forward, and we're able to assist with troubleshooting and creative problem solving. I'm sorry, can you hear the train? So sorry, okay. And we also have some really great existing relationships to help push this project along too. I think we can go on to. So as far as kind of the other, like the site selection incentives process, we are looking at this from a long-term perspective. So we are, again, active listening to what you're doing. We're trying to decide with you the best way to move forward, matching up, you know, the activities that you are doing with the available local and state incentives. We're trying to make, you know, if there are multiple incentives available, make sure that we're picking the ones that are most useful for you to offset your costs. And then once we are able to do that, we negotiate those with the local and state EDOs and EDCs, put those agreements in place. And part of that means that we're reading those agreements and we're making sure to tell you what those agreements actually say. So looking for pitfalls, looking for, you know, things that you have to do that are in those agreements that maybe you might not otherwise understand that you have to do in order to maintain that agreement for audit purposes or other purposes down the road. And then finally, you know, when compliance, you know, comes around, you need to know exactly what that compliance means. Is it an annual report? Is it, you know, what do you need to send in? Is it an employment report? What does the employment report need to be? And so, you know, having that laid out before you sign an agreement and understanding, you know, what all that means is just really important, you know, for return on investment. You want to move forward. So that's very important. So basically, why do we have economic development? It's all about the retention and creation of jobs in a community. And incentives, incentives really help. Site selection and incentives is all about increasing wealth or raising the standard of living within a community. And competition for these jobs is pretty fierce. So communities, they want to attract these jobs and these companies to their area. Incentives are short-term in nature, but the companies establishing their locations will stay long-term. So again, we're looking at a long-term perspective. So an incentive, even if it's 10 years long, a manufacturing company isn't going to pull up stakes after 10 years and just move. So that tax base that they're creating is going to stay, even if there aren't incentives after that time period. So yes, tools employed by governments to attract incentives. I think we just kind of discussed this, but basically, so it kind of levels the playing field, so to speak. So if you are in a very highly desirable area, then you might, then companies want to be there. People want to be in that space, so there might not be very many incentives. But if you're in a rural area that might have workforce challenges, then you might have to give a company something to attract them to be there, whether it's reduced price land or a training grant. So there might be something that that rural community has to do to help convince that company to come there. So an incentive is very useful when you're dealing with those sorts of issues. So it does enhance competitiveness, it does attract jobs, and if you can do that over and over in a community, then you start to gain traction. So that's why we have these incentives. So triggering events, if you're adding jobs, you're making a capital investment, or you're adding square footage, you should be investigating incentives. The minimum number of jobs for these types of incentives, 15 new jobs or more over a 3 to 5 year period, you should be looking at incentives. So you can assign between $5,000 to $10,000 per new job for those positions in incentives. And that would be over a 5 to 10 year period. So it does make sense. There are ways to look up incentives. Chances are your competitors are probably looking them up or even using them. So investigating them does make sense. At least try to find out what's available. So you can look these up on your local or state economic development websites. That is one way to do this, which is very helpful, just to know your options. And kinds of incentives here. I think triggering events here, I think specifically regional development initiatives are interesting. Something like states are trying to attract, let's say, data center projects, or they're trying to have some sort of strategic industry development like med tech. Those do happen. And then, of course, I think there's another triggering event here. VCI tax credits are now becoming tradable or sellable, which a VCI means venture capital investment tax credits. So that is something that's great, because at this, if you are an out-of-state investor and you're investing into a company and it's in a different state, then you can sell those tax credits to someone in state so that it's worth something to you, which is very useful. So there are a lot of different triggering events for these incentives. Poll question. So what is the biggest obstacle your company faces in applying for tax credits and incentives? Understanding the available credits and incentives, navigating the application process, evaluating compliance and documentation, identifying which credits best fit our business needs, or lack of internal resources to manage the process. And we're at about 70% voted. But it looks really like understanding the available credits and incentives is the highest with 52% of the vote.
Yeah.
So that's quite a bit. And it is confusing because there are so many available. And it's confusing because every city, county, and state does it differently. Different programs, different rules, different regulations, different terms, different agreements. So yeah, it is confusing. That is kind of why it's good to have someone to consult with to talk about that. So yes. So different kinds of tax credits. There are two different kinds. I'm just going to talk about discretionary. So typically I work with local, state, and discretionary tax credits. Discretionary means that we can negotiate these incentives. It also means that there is some kind of competitive angle to the project. So discretionary incentives, I like them because you can tell your story. You can look at your project and pitch the state, the city and the state like they're an investor because they're using taxpayer funds to invest into your company. That's basically what it is. And so you're telling your story, and it's invest in our company because we're going to give it our best shot to create these jobs, make this capital investment, and grow our company in your state. So I'm going to create my tax base. I'm going to help you create a tax base. So how can you help me grow my company? So really that's the angle that we want to take. And the competitive part of it can be any number of things. So it could be a but-for clause, but for these incentives, we might not be able to do this project the way we want. Or it could be remote workers, or it could be an actual other site in another state that you're considering. There's a lot of different ways that you can look at this. So, of course, I would say, like it says here, focus on the states with the best return on investment and the easiest states to work in. So, notorious difficult states to work in: California, Illinois, New Jersey, New York. Those are harder states to work in. Challenging is a better word, sorry. Challenging states to work in. Midwest and Southeast is typically easy, a little easier, a little more straightforward.
And I think, Jenny, one of the things we want to make sure that everybody on the webinar understands is that often it's very important to engage in pursuing and negotiating these incentives before taking any action, which could mean signing a lease or starting to employ new employees in a region. That's why it's really important to make sure to engage with somebody who has very familiar experience with these programs, because if somebody commits to a lease before starting this process, then that could immediately disqualify them from gaining some of these benefits.
Yeah, you cannot go backwards. You cannot go retroactive. So if you are actively hiring people, you know, if you have a job creation tax, if you want a job creation tax credit and you want to get the full benefit of that, you have to plan that out, negotiate, get that in place with the state, sign your agreement, and then hire. Otherwise, those tax credits are not going to count. So, yeah. Thanks for that. I appreciate that. So job creation, these are all kinds of amazing incentives. This is definitely not a complete list, but job creation tax credits are really awesome. If you are hiring new jobs, this is one of the best ones that you can get. It's basically getting part of your withholding tax back. If you do not have a liability, many times you can get a refund. So it's a refundable tax credit. There are some that are non-refundable, so that means it's a carry forward toward your future tax liabilities. Training assistance, any kind of training grants, that's great to offset your training costs. Typically, that's shorter in nature, like a 2 to 3 year program, whereas an investment or job creation tax credit can go out 8 to 10 or 12 years. Yeah, so there are just too many to list, and there are many that are not on here. They're free or reduced price land. Oh, there it is, free or market real estate. Exactly. So it really depends on what you are doing. What are your company's specific plans? What is important to you? What do you need in order to grow your company? So it is a very specific, it's very specific to what you need. So it's a tailor-made thing.
Absolutely. Thank you,
Yeah,
Jenny. Did you have anything else to add?
I was just going to hand it right over to you. Thank you.
Great minds think alike. So as you can tell, Jenny and I work very closely together, and the services that I help support and my focus within our practice relates to what are called statutory credits. So unlike the discretionary credits and incentives that Jenny was describing, which often include a negotiation and a letter of commitment and sometimes but-for language, the credits that I look at focus more on what we call by right. So these are programs designed by the government also to encourage economic development growth, workforce development, anything to improve the quality of life in communities. These are just established by right credits. Any organization that is for profit may participate. Some nonprofits are able to take advantage of different credits available to help offset payroll tax liabilities since they don't have federal income tax. Most of these, like I said, are statutory, meaning by right. They've been written into the tax codes either at the federal, state, or local level, and they can be offered for either hiring or retaining employees. There are some specific to encouraging employers to hire veterans or individuals who have some kind of barrier to the workforce, whether it be a disability or being unemployed long term or just new to entering into the workforce. It's very important to understand that, again, both the federal IRS as well as state taxing agencies support these programs. And there are, like Jenny was describing, there are a multitude of different qualifying triggers, programs, different timelines, different requirements. So it's really important to understand, based on every state and even at the county level, what is available to you and your organization. So some of these tax credits I'm describing are listed here. WOTC, Work Opportunity Tax Credit, and the Federal Empowerment Zone are probably what are the easiest to begin a tax credit program for any employer. The Work Opportunity Tax Credit is a certifiable credit where the Federal Empowerment Zone is not, and we'll get into some more of the details of both of those programs a little later on. But I've listed out here a few other programs available. The FICA tax tip credit, we've heard a lot in the news lately about the taxation of tips for employers as well as employees. There is a credit available to employers for the FICA portion of what they're paying to employees that are tipped. Investment tax credits, if you're investing in a certain area, some states will offer a rebate back, if you will, applying against your state tax liability to offset the cost of your investments. They're obviously encouraging organizations to create new jobs, uh, social responsibility, as well as environmental and resiliency credits. These are really growing quite a bit now, along with the veteran incentives. And then in certain instances, there are also film production and cannabis related tax credits available. One of the importance to highlight both of our services is the importance of evaluating locations before you begin any kind of project. So some of those factors, again, are capital investment. How much are you willing to invest in your growth strategy? How many jobs do you think you're going to need to fulfill your goals as an organization? What are those wages and benefits going to be for the success of your company? What are the targeted industries and sectors that states or federal governments are looking to incentivize? What kind of technology and innovation are you implementing? There are different programs available to help, again, offset those costs for companies. How will your project impact the environment? Sustainability, meaning, we've seen recently, unfortunately, in the Southeast, quite a bit of devastation. And there are now incentives and programs and consortiums available for companies who are really focused on building for the next generation to reduce the impact of storms, climate change, anything that might be a disruptor for business today. And then again, like Jenny was highlighting, different regions have developmental objectives. Some areas are focusing on data centers, some are focusing on storage, cold storage facilities. It's all a matter of what's important and what each region is finding is most beneficial for the areas where they have a workforce. And then, of course, the long-term economic impact. What will your project, what will your company have in terms of an economic impact long-term? So all of these factors really need to be taken into consideration when moving forward during this process. As I mentioned, a very easy entry program to highlight is the Federal Empowerment Zone credit. It is a statutory credit, does not require a certification, nor an application, nor any kind of approval. However, when you're looking at your existing locations and any future prospective locations, it's important to look to see if they are within a federal empowerment zone boundary. If they are, then an employer is allowed to take a federal income tax credit equal to 20% of the first $15,000 in wages paid to a resident of that zone. That can maximize value of $3,000 a year per employee per year that that employee continues to work for the employer. If the current year liability or your current year tax credit exceeds your liability, you may carry this credit back 1 year, or you may carry it forward for 20 years. It is a non-refundable credit, so you definitely want to make sure that you plan accordingly. But as you're seeing your company grow or you're considering locations of where to do business, this is a really nice federal program that will overlay on top of the discretionary incentives that Jenny was describing, and maybe taken in addition to other federal and state tax credits that are statutory in nature. And with this, we'll pause for our third polling question.
Okay, which area would your company benefit from the most in terms of available incentives? Job creation and workforce development, capital investment and infrastructure improvements, research and development initiatives, energy efficiency or sustainability projects, or not sure where to start. Okay. Looks like it's pretty close, actually. Capital investment in infrastructure improvements are at 34%. Job creation is at 25%. And not sure where to start is 21. So that's almost a three-way tie. So that's very interesting.
Yeah, well, now we can understand why it's important to have these sessions, and very excited to hopefully assist and be a part of helping those individuals who aren't sure where to start. Quite honestly, it's very common. Um, those results are not surprising to me. I'm sure not to you either, Jenny.
Absolutely.
Well, I'll go ahead and let you talk about how to maximize these benefits.
Certainly. So the best thing you can do is tell your story from your perspective. Who you are, why are you good at what you do, and why are you growing? What are the things that are happening in your world that are propelling you forward? Cities and states love to hear that from you. And know your audience. So do a little bit of homework on the people that you're meeting. And give the most appropriate information you can. So just understand that you might be a technical person and might want to talk about all of those kinds of things with everyone, but the city and state are really going to want to know about how many jobs are you going to create, and what's your capital investment? What are you going to buy, or what are you investing in? Are you adding any more square footage? What is your current square footage? And what's your timeline for everything? What kind of equipment are you buying? Those are all the things that the cities and states are interested in, because that's how they are, creating the tax base. Beyond that, think about what you need in order to grow. What's important to you as a company? Do you need a qualified workforce in a specific industry or specific type of training? Do you need, month-to-month lease until you find out where you really need to, grow? Do you need a specific innovative piece of equipment? So just think about, what your ask would be. So just knowing, having a plan, I guess, is the right thing. It's having a plan. And then something that is definitely coming up more and more are these sustainability practice questions. So how are you giving back to your community? This is definitely a part that you should address. And then ask some specific questions about the process, about the programs and how they work. And then also ask about the compliance and how the benefits are received. So you want to make sure that you understand the entire process, so that is it worth my time to do this? Because sometimes programs are a lot of trouble. Lots and lots of work goes into those programs, and then the benefit is maybe not worth the effort. It does happen. So you just have to ask the questions and evaluate that for yourself to see if you think it's worth it.
Great points. And one of the things I would like to highlight here as well is that, as you were describing, Jenny, with all the different pieces of information of what an organization may be disclosing to a state or local agency, there are confidentiality agreements in place usually. So companies can rest assured that if you are sharing this information with a state or federal agency, they will be bound to those confidentiality agreements, and they will not be made public. So any information will not be disclosed until you are ready to disclose it for an appropriate project if need be.
Okay, so this remote worker policies have kind of come to the forefront in recent years. Yes, COVID had something to do with this. So when People went home. Many did not necessarily want to come back into the office to work. So that affected some, job creation tax credits and some other incentives. But, before, everyone who was receiving these job creation tax credits had to come into a specific office. So they were tied to a specific location. So now what's happening is Indiana and many other states are declaring that you do not have to be tied to a specific office to qualify for this program. So you could have an office or not have an office. You could just have, as long as you have a full-time employee that's an Indiana resident, they will qualify for this program. And many states have this as well. Not every state does have this, but Indiana does. So it's very nice. So there are some, the winds of change have blown, so to speak, and it's been a favorable development.
Agreed. I think the more we see legislative changes across the board, more and more states are recognizing that the workforce has changed after the pandemic, and these policies, these credits and programs and incentives have all been adapting along with the new change. So the remote workforce has, to your point, really been adopted more, I would say, across the country. And to dovetail along with the workforce across the country, uh, I'm going to highlight as an example the Work Opportunity Tax Credit, which is one of the federal programs I mentioned earlier on. It is a statutory credit. However, it does require a certificate from the state workforce agency where your employees are working. It works in conjunction with other programs. So this is a federal income tax credit available to all for-profit employers to incentivize a more diverse workforce, again, assisting individuals who may have some barrier to the workforce, uh, which could be, again, veterans returning from service. Some of these benefits can result in a maximum of $9,600 as an income tax credit to an employer. There are about close to 30 different categories in which an individual could qualify for. There's no limit in terms of how much credit you can capture and claim on your annual income tax return. But it does require, again, some rather cumbersome and administratively heavy burdens for employers. It is a prospective credit, so you cannot look back retroactively. It does apply to only new hires, so rehires would not qualify for an employer. It does have, again, with that application process, a 28 calendar day window timeline that is built in. It is not negotiable. And literally, if you miss one day in submitting an application to a state workforce agency, then that opportunity is what we call lost. You're unable to submit it. The states will not even accept it. And you miss out on the chance to potentially earn thousands of dollars in federal income tax credits. This, again, can be carried back 1 year or forward up to 20. And this is a program that's been around since the 1990s. It has changed a little bit here and there and is currently set to expire next year. I bring that up because more than likely we'll hear about this over the next year. Over the years, Congress has always renewed the program, extended it. There is talk and consideration that the IRS may codify this in the future. We aren't sure what will happen. I don't know what will happen in 60 days, but I will tell you that this program has been very well established. There have been loads of investments made to move the workflow and the application and certification process to a fully electronic process now, which relieves the burden on both the employer as well as the state to really improve the efficiency of how this program works. But it is a wonderful program that if your organization is not taking advantage of, should really look into capturing going forward. And with that, um, we'll talk about the application process for both site selection as well as the statutory credits. So with the incentives that Jenny was describing, in addition to the statutory credits that I've been describing, it's important to really make sure that you understand that sometimes you will need to screen, whether it be a new employee or you're going to have to screen your region and area of where you're looking to do business. It's important to have any kind of application submitted on the front end. Like I mentioned before, if you commit to a project or a building or a job creation within a state, from a discretionary perspective, you will not be able to be eligible for those programs in most cases. So it's important to really, again, be thinking this through on the front end proactively, strategically, in order for you to maximize the benefits of these programs available to companies. Documentation and record keeping is key, essential, foundation. I can't emphasize the importance of documentation and record keeping. For any of these programs, whether it's statutory or discretionary, it's important to have audit-ready documentation. When applying for the discretionary incentives and having that reporting and compliance, incredibly important to have all that information on the front end, just to make sure that you're accurately reporting and documenting all of your activities, again, to ensure that you're receiving that maximum credit value. And again, filing everything completely, answering every question. I can't tell you how often I've heard that some companies have applied for, whether it be a negotiated incentive or a job creation credit, and they've missed one or two questions. They just didn't answer it, or they didn't understand what they were answering. They missed the mark on what their answer was. And the agencies reviewing these don't have that relationship with employers usually. So they have to move on and take action on the information in front of them. So if you are not filling out those applications entirely, that could disqualify you. And again, you could miss out on some significant credits or savings.
And just to add
Jen,
to what Sabrina
yeah,
said, yeah, just to add to what you're saying, I think it's important to say with this record keeping, these these programs go usually 10 years plus 2 years post-term reporting. And at any time, if you are not keeping these records, you might think that you could call the state and ask them to send you the records that you previously submitted. But because it's very sensitive information, they are not going to share that with you. So it's really difficult if you are not keeping records. I've had this come up many, many times, and clients going through audits have to try to recreate what they've submitted, and it is very difficult. And it does happen where clients have to pay money back if they can't prove what they previously submitted. So there are clawbacks that can happen if record keeping does not happen the correct way. Just weighing in.
great points. And you brought up another area that I want to highlight as well. A lot of these forms, the applications, as well as the compliance reporting that we'll get into, does contain personally identifiable information, also known as PII. So it's very important that you're ensuring that you're using a secure method for transmitting this information. Not everybody takes the proper precautions for protecting that data. So it's important that when you're working with somebody, or if you're managing this independently, you want to make sure that you do have the proper security protocols so that there isn't a breach of employee data. We just wanted to throw in a little highlight here of an illustration of the workflow for, we're using WOTC as an example here, but this could apply to, again, the discretionary incentives that Jenny was describing earlier, as well as some of the other state statutory programs that do require an application. So just starting off here, we have an applicant wants to apply for a position with an employer. They submit their questionnaire. They're entering in where they live, what they do, their resume. And usually we found that we find that the best time to screen for these tax credits as well. Very easy form, have the applicant complete it, it's on hand. If the employer chooses to hire that individual, then that information is sent on to a state workforce agency to have it evaluated and hopefully certified. For some of the categories, there is a little bit of backup documentation needed. So the state would work with the employer or the third-party vendor to assist with those needs. Then once the state has everything that they need to make the determination, they would certify an employee, send it back, and then there's a process of documenting and calculating and tracking the wages paid and the hours worked for those employees. Again, this would work even on a greater scale. I know in California they have the Cal Competes program, and that's a 5-year program. Not as detailed with the certification, but there are benchmarks very similar to this workflow that would be modified and to follow as well for that program. And with that, we'll go ahead and take a moment for our last poll question.
Okay, how confident are you in your company's understanding of the incentive programs available at the local, state, and federal level? Very confident. We often take advantage of these programs. Somewhat confident, but we need more clarity on the specifics. Neutral, aware of programs but don't fully understand them. Or not confident, very little experience with these. And I can't see the very bottom one, but I bet it means we don't know them at all. And I would say it's 36% neutral, not aware of the programs, but not fully understand them would be the biggest category there. So yeah, I would say that that's to be expected. There are a lot of programs out there. It's hard to really understand many of those. It's just, they're everywhere at this point. You hear about them all the time in the news. You see them advertised and popping up in the news. So not
Absolutely. Well, I think that's a testament also as to how our industry was created. Last I checked, there were over 3,000 credits and incentives available throughout the country. And that's not even including international programs. So I'm not surprised to have the polling answers be what they are, given that we'll often hear about different programs or you'll see a soundbite or something. And but to really understand the nuances and the details of all these programs, it does take a full-time job that most organizations don't have dedicated internally.
But don't you think this is kind of a nice point to make too, that most people think they'll see an announcement in the paper of a very large company making a very large investment and they're getting, millions of dollars of incentives. But the fact is that you don't have to have a very large company creating hundreds of jobs in order to get these incentives. These are available for very, I say very small, but small companies, companies that are 10 or 20 people strong, companies that have 50 employees that are growing by 15 employees. They're available to you. So don't think that you have to have a large company in order to take advantage of these incentives.
Great point, Jenny. And one of my favorite clients that I used to have that we've talked about had a very limited number of restaurants. And when they first started, they weren't quite sure where they were growing, what they wanted to do. And by working with individuals like myself and you who have the experience and the expertise to help guide them, they've now become a national publicly traded restaurant that utilized and implemented some of these strategies that we're describing. I mean, I know you've had some great success with some startups, really getting to the next level. And to your point, utilizing these programs and the benefits of them to invest in themselves and grow to become even greater than I think they envisioned originally.
Yeah, it helps to offset their costs and reinvest into the company. Absolutely.
Absolutely. So here, just wanted to highlight again the importance of compliance and why it's important for best practices. Um, Jenny and I have both described how it's important to make sure that you're adhering to legal requirements. States will come back for funding if you do not fulfill your full obligation. And to Jenny's point, some of these programs and some of these agreements can be long term, even for the short term. If you have a statutory credit that you claim for your annual tax return, you want to make sure that you have all the documentation on the front end before you even claim that credit. So it's important to really understand the requirements, the statutes, and that you've followed all of the steps in order to claim that credit properly. This is by far the most important piece of everything that we've been describing today. And Jenny, to your point, when individuals we all hear about a big project. I know when Amazon was searching for their HQ2, that was in the news almost every day, it seemed. And you heard about all these different incentives. And then when they made the big announcement, everybody celebrated. But this is really where, what I like to say, where the rubber meets the road, if you will. Compliance is where you have to make sure that you are fulfilling that obligation, or else all of that work, all of that celebration on the front end really isn't monetized. So the benefit isn't realized or recognized by an organization if you don't fully commit to what it is that you've agreed to with the different agencies. And again, it builds trust, it reduces potential risk. And nowadays, with social media, it's very important to establish that transparency and maintain integrity for an organization within a community.
And just to add to that, I just want to make sure to just add that these programs that do have different rules and regulations that we are talking about, they really are across the board different, meaning some of them are performance-based programs. So that means you will receive to the level that you perform. You receive an incentive to the level that you perform. But it doesn't matter if it's a performance-based or it's, statutory, you receive, you have to commit and then you receive the amount on an, quarterly, annual, whatever basis it might be. They all do absolutely 100% require compliance. You do not get the benefit if you do not file.
Great points. And to go along with compliance, we have the reporting. Again, that is where you take the information that you have compiled through the project or the scope of your activities, and you report it in a timely manner. Again, making sure that you're aware of what that timeline is, whether it's monthly, quarterly, annually, to make sure that you're communicating consistently, so that everybody is aware. Again, the purpose of these programs is really for everyone to win. The employer benefits from these programs being provided by the appropriate agency. The agency benefits because, again, they're improving the quality of life where their tax base is, and by creating jobs or investing in these areas, they're seeing a benefit to their community. And then down to the individual employees, they're benefiting with these new jobs, great benefits and a better quality of life where they're choosing to work as well. Jenny, did you have anything to add?
No, I think you said that very well. Thank you.
Well, and this will be our last slide for today. Uh, Again, these do tip the balance. Great point, Jenny. Between similar sites by allowing an organization to really understand the difference between different locations or when they're considering their next steps. Um, these will offset those costs, thus driving higher profits. Anytime you can reduce your tax liability, it allows an organization to really use that funding to reinvest in the organization, in training of their employees, or the next new location or implementation of new technology. This encourages upskilling for communities, transferable skills. Sometimes we don't recognize that the skills of today, as we're training, really do help employees transition to that next generation of implementing those skills that they're learning today, which does strengthen a local workforce. You know, any kind of good news kind of fosters more good news. So these programs really do help drive that cycle, if you will, and that attractability. And then overall, it collectively lowers costs for everybody. When everybody's working together, there's an efficient flow of activities throughout the community, which really builds upon itself to be, again, a better environment for everybody. And then it does help level the playing field for everybody. To your point, Jenny, small companies are looked at just as importantly and equally as a very large company. It's just a matter of, again, telling that story, understanding what it is that a company is trying to achieve, and the benefit that they're going to be bringing to the communities where they're establishing their footprints. Jenny, did you have any final thoughts?
Again, very eloquently stated. Thank you so much. We do have some questions from the audience, though.
And I will say we're on a tight minute, so we'll go ahead and take one question.
So, question from the audience: where can I go to find credits or incentives specific to my state or county? Do you want to take that one?
Sure. Great question. There are multiple places to find this. Your economic development offices, your state Department of Revenue websites. Again, there are multiple areas where you can find this information. There isn't one specific place to find all of that. So again, reaching out to individuals within the community, asking somebody who is familiar with this would be probably your best recommended path.
Do we have time for one more?
We're at 59 minutes, so I think I want to go ahead and close up if that's all right.
Sounds good.
Excellent. We will, sorry about that. This does conclude today's webinar. We do value your feedback, so please take the brief survey that will pop up at the end of this webinar. CPE certificates will be emailed within the next 2 to 3 business days. And if we didn't get to your question, which I'm so sorry, a member of our team will be following up with you to make sure that we do provide you the full answer to your questions. We thank you for attending today, and we hope that everybody has a delightful day. If you have any questions, both Jenny and I have included our contact information. We are both on LinkedIn. We recommend that you reach out to us, and we're always happy to help and provide any kind of insights possible.
Yes, thank you so much.